Hey guys, welcome back to a brand new video. I'm Rex Finance, and today we have to talk about this never-ending V rally that a lot of retail investors are honestly getting tired of. Today might have been one of the most extreme examples we've seen of this, but I was watching futures and pre-market trading, watching how the NASDAQ was going up and down because this morning we got new inflation data, and I'll get into that, but futures were bright green, and then they went bright red, and then at market open, the markets actually went green before falling from their highs about 1.5% by 11:30 in the morning. And from there came our lovely V, where we rallied the rest of the day and actually ended the day green by 0.2%. I actually made a quick trade on this today. I timed the bottom about perfectly. I'll put it up on the screen. I didn't use any technical analysis or anything, but when everybody was emotional and upset that the markets were going red, I took the opportunity to make a money decision. I don't do this very often, but whenever I see a short-term opportunity, I take a chance with a small amount of capital, and that's what I did today. I'll always be a long-term investor, but when I see an opportunity, you best know I'm going to take that opportunity. And I posted this in the members-only Discord server, so if you want access to the membership to get my buy and sell alerts, all you have to do is hit the join button down below, located right next to the subscribe button, or hit my Patreon link in the pinned comment. But yeah, that was a nice $300 turned into $2,000 today. That's always a good day. But what was the reason for the market going so red at first today? Well, it was that CPI inflation report that we got this morning, where consumer prices rose more than expected. They rose 3.4%, and the estimate was for them to rise 3.2%. So inflation was 0.2 higher than the markets anticipated, meaning inflation actually ticked back up, which that doesn't sound very good. And it took the market some time to figure this out, but this was really kind of a misleading report where the year-over-year comparisons weren't favorable. You also had a very strange rising shelter costs that accounted for more than half of the core CPI increase in December. That's not going to happen. I don't think that the real estate market is going to crash. I don't think the real estate market is going to keep going up either. I expect shelter costs to remain relatively flat year over year, which in the end will bring inflation back down to the 2% goal, or maybe even slightly below the 2%. But if I asked any random person that's watching this video right now if you thought inflation was going up or coming down right now, there's a 99% chance that that person would answer, yeah, it's coming down, and it's very apparent this is no longer an argument. Inflation is trending downwards, which is very, very good. We just don't want it to go too far into deflationary territory. But we can even see evidence of this in the data itself. We've known for a long time now that the goods sector of our economy was deflating or disinflating. That is the blue line on this chart. And this battle against inflation was really a battle against services inflation, because the services side of our economy has remained so dang strong. But you can see even recently, the services inflation has been ticking down. And I made the comment in the Discord server, from here on out with CPI data, unless we have a number that comes out that beats or misses by an extremely wide margin, the markets likely aren't going to move very much, because everybody knows inflation is on the downwards trajectory. So unless we have a huge miss or a beat showing that deflation is coming or that inflation really is resurging, the markets aren't going to move that much. And I think that's why the markets came V'ing back today, for lack of better words. But if it weren't for Nvidia, again, the markets would have actually ended the day red. Nvidia was a big reason for this V rally in the stock market. And Nvidia has been on fire. Yesterday, I went through in my video why Nvidia stock is actually cheap right now. I give you the data. So if you missed that video, go watch it. Just click the eye in the top right-hand corner. It's easy to open a new tab. Watch that after this video. But Nvidia stock is cheap right now according to historical standards. And if Nvidia stock is cheap and it keeps going up, that's going to mean very, very good things for the stock market in 2024. But I'll tell you what, if there's a stock that's not having it this year so far, it's Tesla. This year to date, Tesla is down by more than 9%, and today the stock was down almost 3% and down another 72 basis points after hours. Safe to say Tesla does not like 2024 so far. And you may look at Tesla's 66, almost a 67 forward PE multiple and say, yeah, Tesla should sell off because it's too expensive. But this is actually the opposite of what I discussed with Nvidia yesterday. Tesla may actually be cheap at a 67 forward PE ratio. And let me show you why that is. First of all, look at analysts' average forecasts for Tesla's forward operating earnings per share. Look how these estimations have come down significantly since the beginning of 2023. Obviously, it makes sense. Tesla has cut the price of their vehicles several times, which is going to hurt gross margin and earnings as a result of that. But even though analysts have been lowering their earnings expectations for Tesla, the stock price really hasn't gone down at all, meaning the stock price has either stayed the same or it's gone up, while earnings forecasts have come down, which is why this forward PE multiple right now is as high as a 67. But again, opposite of Nvidia, who's had their earnings expectations increased tremendously by analysts, Tesla's earnings expectations have come down. The way to reverse this high forward PE multiple, or nullify it, render it useless, is by saying analysts are going to be wrong about Tesla's forward earnings. If analysts are wrong and Tesla's earnings come in higher than expectations, well, then this forward PE ratio is much lower than a 67. And if you want my opinion, I do think analysts' numbers are going to be wrong for 2024. We had Q4 delivery numbers released by Tesla just recently, and you can see that Model 3 and Model Y deliveries actually ended up being lower than expectations, but the other models, so the S and the X, actually had more deliveries than anticipated. And if this is the case, this is going to mean very good things for Tesla's operating earnings per share, because the S and the X are much higher margin vehicles for Tesla than the 3 and the Y are. So although Model 3 and Model Y deliveries missed to the downside, because the S and the X deliveries beat, I'm expecting that to have very positive impact on the company's gross margin and as a result, their earnings per share. We can even look at Standard & Poor's commodities index to see how much commodity prices have come down. So this is lithium, this is nickel, these are the battery components, this is metal, this is everything that is a commodity. Ever since June of 2022, commodities have been in a straight downtrend, down 33%. Now, this is going to take time to hit Tesla's earnings and all these other companies' earnings, but when these decreases in commodity prices do hit their earnings, that is also going to have a very positive impact on gross margin and earnings of these companies. So, although a lot of stocks might look expensive right now, because analysts have been wrong and look like they're going to be wrong in the future, they may not actually be expensive and they may be more on the cheap side. You also have to remember, with a company like Tesla, you are paying a premium to own the fastest growing company in the world. And you know what? It gives me a lot of confidence that despite all of these price cuts on Tesla vehicles, and despite Tesla continuing to massively invest into their business, they've been able to maintain profitability by a wide margin. That's another thing you're paying a premium for. Now, unfortunately, I don't have a crystal ball. These are just my own thoughts and opinions right now, and we will find out on January 24th when Tesla reports their earnings if my thesis is correct or not. If Tesla's earnings come in above analyst expectations, that forward PE multiple is going to come down significantly. And moving on, I know a lot of people have been disheartened that small caps have not had a great start to 2024 either. You have the Russell 2000 down 3% year to date, which is not a good start by any means, but there's a good reason for this, and I've talked about it on my channel several times. The reason small caps are hurting, and another reason Tesla stock is hurting, is because the cost of capital has gone back up slightly since the end of 2023. The markets are starting to realize, crap, maybe we priced in too many rate cuts for 2024, so the market is correcting itself. If the cost of capital goes up, it's going to hurt smaller cap companies that are strapped for cash. And we all know the automotive sector is also very impacted by interest rates. But even though interest rates have gone up to start the year, I believe the long-term trend is downwards, just like inflation. It is in the government's best interest to have low interest rates because of how much debt our government itself has. If they raise interest rates, all of a sudden they have to pay more on interest on their own debt that they have. And if you're still not convinced, just look at forward PE multiples on small cap and mid cap companies right now. Large caps are still elevated, above average, but small and mid cap companies, which are the blue and green lines here, are still much below average with their forward PE multiples. This will change. You can see on the chart, typically small caps and mid caps trade at a higher multiple than large caps, but ever since the pandemic, this has flip-flopped. I expect this to flip-flop back the other direction. The opportunity right now is very clearly in small cap and mid cap companies, and that's where the bulk of my portfolio is positioned right now, and I'm not going to change that. For the next decade or two, it's going to be a very favorable environment for growth companies and smaller companies because the cost of capital is going to be so low. In fact, the only thing that I'm scared of right now is that there's nothing to be scared of. You see, as of now, any bull to bear ratio you look at, so it shows you how bullish or bearish the stock market is at any given point in time, how bullish or bearish retail investors are. Any metric that you look at that measures this shows extreme bullishness in the market right now. And I would argue it's due. I mean, there's a good reason for it. But I'd also be dumb not to acknowledge that when bullishness reaches highs, it's typically time to expect some sort of shakeup in the markets. And I can promise you it will come. There's going to be some event that happens in 2024, or maybe there's 2 or 3 or 4 or 5 events that happen in 2024 that reignite the fear in our stock market. And that's when the opportunity to invest presents itself. And I'm not going to waste any of those opportunities. So if you want to follow along with me and what I'm thinking, make sure you subscribe down below if you're not already. But with that, I'm going to end this video here. It was a quick one. We got in and out of here, but I think there were some important points made here. I believe stocks are cheap right now. I'm bullish on 2024, especially for small cap and mid cap companies. With that, I hope you have a great rest of your day. Keep 10 toes to the ground and your chin up. Stay blessed. Peace out.